Welcome to our webinar on clergy getting smarter on your taxes. We are pleased today to introduce Reverend Ken Sloane and Reverend Don Joyner, who will host this hour-long webinar. I'm Chris Spencer. I'm the president of the United Methodist Foundation of Louisiana, and we're delighted that you've joined us this afternoon. And we hope the information that Ken and Don are going to present this afternoon will be of great benefit to you. Let me introduce Ken first and Don to follow. The Reverend Ken Sloane is the United Methodist Church's Director of Stewardship and Generosity, housed in the Discipleship Ministries office in Nashville. Ken is a clergy member of the Greater New Jersey Conference, where he served 20 plus years in local church ministry, including a successful new church start and 5 years as the Director of Connectional Ministries. The Reverend Don Joyner is an ordained elder in the United Methodist Church, and he served churches and conference staff in the former Detroit Conference. And for 35 years, Don served on the staff of Discipleship Ministries, specializing in stewardship and planned giving. While Don was at the General Board of Discipleship, he published 13 books, including Christians Doing Financial Planning. Don is a certified financial planner specializing in financial planning and tax preparation for clergy. And so we're delighted to have Don joining us today. If you have any questions, please type them in the chat whenever you like, and Ken or Don will address them at the end. We plan to go up until the hour, but longer if needed, if there are more questions. So at this time, I will turn the agenda and the presentation over to Ken and Don.
Okay, well, thank you. Thank you very much. Kelly, do you want me to go ahead and share? Or did you have something you wanted to put up first?
Go ahead. Mine's not till the end, a little promo. So
okay,
for the next webinar. So go ahead.
I'm going to go ahead and put some slides up here in a minute. And let's see how we get that squared away. And I got everybody's pictures up on my other monitor, so bring you down here. And yeah, we're really happy to be able to have this opportunity, this invitation from Louisiana to share this with you. I'm going to move through my stuff kind of quick. Let's see if I can click these. I'm not seeing my thing. Hold on a second, folks. There we go. This is just some contact information for me. And again, for the Office of Stewardship and Generosity, if there's any way that we can help you or support you, we're really happy to do that. We have a Facebook page. We have a web section where I post articles regularly. And once a month, on the second Thursday of each month, we do kind of an open stewardship forum. So if you ever want to join us for that, feel free to register for that. And again, you can find all this information on the web page. Don has been gracious about doing these webinars with me for a number of years, and we do get so many very specific questions that we've compiled a Q&A document, and Kelly is going to email that to you at the end of the webinar, or when she has the recording ready. She's going to email to everybody who's registered, and you'll find the questions are kind of grouped by category, so make it a little easier when you're actually physically sitting to trying to do your work on your taxes. So anyway, so that'll be coming to you in a little bit. Don has already been introduced to you. The part that we didn't put in his introduction is that when I came to discipleship almost 11 years ago, Don was the staff person for stewardship and was my mentor in that process. When Don started out, stewardship was a whole department full of folks. And when I arrived kind of new to the boat, I moved over from United Methodist Communications. Don was there to answer a million questions from me and to be kind of a guide for me. So we discovered this fact that the clergy taxes was a specialty of Don, something he had worked on, but in many places around the conferences in the US, folks really struggled because they weren't getting any decent advice about how clergy taxes are unique. And so we developed this webinar, and Don has been great about updating it along with any new changes that come along. And so without saying more about him, I'm going to turn it over to Don and let him lead it through you. And if you have questions, just put them into that chat window, and we will pick them up at the end. And if you don't have any questions and you need to hop off, feel free to do that. But I'm going to go ahead and let Don start. And let me just tell you, in the organization of this is, the first part of this is Don's going to reflect on some of the things that have kind of changed in recent years that have not been traditional parts of tax preparation. And then the second part, he's really going to get into things a little deeper and give you some examples of how using the advantages that clergy have around taxes and some of the specialties, unique things about us, that by a little planning, a little strategic work, you can really minimize your tax impact and free up some money to help either with your retirement or help manage your finances better. And so I'm not going to say any more about that and let Don pick it up.
Thanks, Ken. I appreciate this opportunity this afternoon to be with you all. I'd like to say when we get started, how did I get involved in doing clergy taxes and financial planning? Many years ago, when I was a young pastor, my family and I went on vacation and came home, and we used the CPA that my in-laws used. Came home to discover that he said I owed more in income tax than I made that year. That didn't seem right. So I started studying it and worked it out, and ended up that the IRS owed me money. I didn't owe them any money. And that got me thinking that clergy taxes and financial planning is so much different than anybody else's. And not all CPAs, tax preparers, financial planners understand clergy. And so I see this as a ministry that I have developed over the year. And that's also why I went back to get my degree as a certified financial planner. That has helped me in my work with clergy, and has helped with my work in plan giving and stewardship over the many years. So I'm glad to be here to share. And I hope during this time that you'll be able to find some insight into how to save and not pay as many taxes as you have been in the past. So we'll get started. You may have received a letter like I did this week from the IRS saying that, reminding us that we need to report the $1,400 each that we received. I think it was back in May. So the economic stimulus check that we received needs to be reported on our taxes. If you did not receive it, or you did not receive enough, you may get credit on your tax return. If you got more than you should have, or because they based it really on 2019, 2020 tax returns, if you received too much, then you don't have to repay it. Also, there is no tax. It's just a reporting part of your payments. And I think that's reported on line 30 of your 1040. Again, if you receive too much, you don't need to pay it back. If you didn't receive enough, you'll get credit. Back in 2020, there was a Consolidated Appropriations Act that instituted a number of changes. One thing they did was reinstate a mortgage insurance premium deduction. If you itemize on Schedule A, and we'll talk about this later, most of us will not, you could now start recording that mortgage insurance premium that you've been paying. Also, the qualified medical expense was 10% and has been reinstated to 7.5%. That means, again, if you itemize, you're able to deduct anything above 7.5% of your adjusted gross income as a medical expense. What is a medical expense? if insurance, medical, doctors, dentists, chiropractors, medical, drug expenses, all of those are qualified medical expenses. Also, if you have qualified tuition and related expenses, you can start deducting that above the line, meaning you don't have to put it in on Schedule A. Even if you don't itemize, you still get this tuition and related expenses. Let me say a word about those related expenses for education. Primarily for most of us, that will affect our children, that we're paying those bills. It does not include housing, but it includes all the fees, books, expenses to be in school. Also, in this Consolidated Appropriations Act, the required minimum distribution, which used to be when you had to start taking it once you were 70 and a half, has now been increased to age 72, starting in the 2020 tax year. That I expect in the next year or so for that to be increased even more. People are working later, getting that, forcing people to take that at even age 72 for some is a big strain. Also, for 2021 is an increase in the standard deduction. You used to have to list all your deductions, and also there was a personal exemption. There is no longer a personal exemption, but the standard deduction has been increased so large that most people today will not itemize. I always suggest copying all that information down, put it on your tax return, and see if you come up above what you're going to get as a standard deduction. For couples, you're going to get $25,100, even if you don't itemize. And for each person over 65, you'll get an additional $1,350. Singles, you can see there, and head of household. So look at that carefully, don't miss it. It'll make a big difference. That reduces your taxable income by that amount of money. Also, as part of the CARES Act, which brought the PPP loans to many of our churches, has changed. Even if you don't itemize on Schedule A, you're allowed an above the line charitable deduction of $300 a person or $600 for an individual. This was increased from the previous year's tax return, which was limited only to $300. So even if you don't itemize on a joint return, you can get a $600 charitable deduction. Again, you do not have to itemize to get this. This may not hit too many of us, but the mortgage interest deduction is limited to mortgages under $750,000 for primary residence and a second home combined. So if you have a mortgage, not a value of the house, but a mortgage of under $750,000, you can deduct the interest if you itemize. Also, primary residence property tax, as well as state income tax and sales tax deductions, it limited to $10,000. It used to be that I would have people deduct their property tax one year, skip the next year, double up, but this kind of eliminates that possibility for a lot of people. Also, one of the things that is important for all of us clergy is that the deduction for moving expense is gone. You could no longer deduct moving expense. Now, the tragedy for this is if someone else has paid your moving expense, your local church, the conference, they have to report it to you as income, but you don't have a place to deduct it anymore. I'll say a word about this later, but you could include that as part of your housing allowance expense. So let's not lose it altogether. Also, previously, there was a miscellaneous expense deduction on Schedule A, limited to 2% of the adjusted gross income. That's gone. That whole line is gone. There's no longer a deduction for employee business expense on Schedule A. There's no longer a deduction for tax preparation fees, safety deposit fees, brokerage fees. All of those expenses are now gone. So you don't have them at all. One of the big questions we get, because so many more people are working from home, is that there is no deduction for home office expenses. So if you bought equipment to keep in touch with anybody, you have an office in the home, whatever expense you have there is not deductible on your Schedule A. We'll talk about how to deduct some of it later on, but basically there's no home office deduction. Really, you should line it up in your accountable reimbursement plan that you have set up with the church in terms of any kind of business expenses to reimburse you for those expenses that are higher now because you may not be working at the church or at an office. Even though you may not be able to deduct those expenses as an employee, clergy are also self-employed for all income purposes, and you could use those expenses, we'll show later, to reduce your self-employment tax. One of the things that's probably going to cause more problems this year than anything is the child tax credit. Child tax credit was $2,000 for every child under 17. That was changed this past year to $3,600 for children 5 and under, and $3,000 per child ages 6 to 17. The 17 is new. It used to be it had to be under 17, but if you have a child at 17, they're also all included. That's whatever the child's age was on December 31 of 2021. One of the things that's going to mess it up is starting in July, they started sending out an advance child tax credit payments. Unless you opted out, you got that money, you need to report it. It's going to, if you were counting on the child tax credit as in the past, then you may be surprised by this because you have to report the money that you got in advance payments to reduce your credit for the year. You should receive, and I just got this notice, IRS is mailing a letter out called 6419. 6419. That letter will confirm how much you received in advanced child tax credit. You have to report that. And that's going to confuse a lot of people. If you don't report it, you're going to end up taking too big of a child tax credit, and you're going to owe the government more money and probably a penalty for not reporting it. Each, in terms of a married couple, each of the spouses will get one of those letters. So make sure that you count it from both of them. Basically, there are 7 tax brackets for individuals, as you can see on the board. most of us will be in a 12% tax bracket. That 12% tax bracket is for any taxable income, not all income, but taxable income for a joint return of up to $81,050. Anything, what's confusing for a lot of people is if you make more than that 81,000, only what's above that line gets taxed at the next highest tax bracket. So you can see what it is for jointly, singles, and head of households. So most of us will fall in the 12% tax bracket.
So John, let me just make sure that's clear to folks. So we always talk about something moving you into a higher tax bracket, but if you were to go over the $81,050 by $500 or $1,000, it was just that part that's over that would be taxed at 22%. Is that right?
That's correct.
Okay.
But that's a question I get all the time is, does that it jump me up to a bigger bracket? So the 22 bracket is above that. Other changes, estate tax has changed. I think the figure is that federal estate tax is anything above $11 million from your estate. I'm still waiting to figure out how I get anywhere close to that. But most states are beginning also to eliminate the estate tax. I believe in one way to balance the budget in the next years or so, that estate tax may fall back down to $3.5 million. So anything above that would be subject to federal estate tax. Also, we used to have to report that we do have health insurance. That mandate to report it has been eliminated. Hopefully you have health insurance, but you don't have to report it unless you're on the health reserve and you're getting part of your health insurance paid for by the federal government. Then you have to report it, and you'll get a form 1095A, I think it's considered. Clergy taxes and finances are unique. That's what I want to say all the way through here. Clergy have limited income. A lot of times when I meet with lay people and we're having problems with their income, I'll say, you might for a short time want to get a second job. I can't say that to clergy because basically the discipline lays out that our full-time job and no other is what we have with the church. Any other income that you get is also charged as self-employment income. And we'll talk about that later on, but that's very different. That means that we are employees for the money that we get from the local church. But at the same time, the church can't pay our Medicare and Social Security tax. We are self-employed and we have to pay that on our own. So that means we're both employee and self-employed at the same time for the same money. And we'll talk about how to figure that out later on. Also, the itinerancy limits what we can do because we tend to move more often. Most of the people that I know stay in the same job all their life. We don't do that, we move. Because clergy move, that also often limits job possibilities for spouses. And oftentimes we move and we may move too far away from where our spouse worked. And that challenges a lot of things in the clergy and spouses relationship. Also, we have a limited investment for housing. Most of the people I talk to have lived in their home for a long time. They get ready to retire and they pay off the house. Because we move around, because we may live in a parsonage, because we buy and sell every time we may need to move, we have limited investment. But I also want to say, and I'll say that later on, clergy should not pay off their mortgage when they retire. That's different than I tell lay people. Living in a parsonage is taxable. Most people don't realize, and most lay people don't even realize that. The value of living in a parsonage needs to be added in for self-employment tax purposes, so that we have to pay taxes just for the privilege of living in a parsonage. Also, any gifts from the church or through the church are taxable. People will often say, Pastor, we want to make this gift to you because you did my daughter's wedding or baptism or funeral. All those are not gifts. They are taxable income and need to be reported on a Schedule SC as taxable income to you. Also, if in some of our churches, they gather money at different times, oftentimes around the Christmas holidays, and they gather gifts from members of the church and give it to the pastor and say, this is a gift from us. It is not a gift. It is taxable income and needs to be added. If the church is paying you, needs to be added back on your W-2. Also, clergy need to pay estimated tax instead of having anything withheld. It's better if the church does not withhold. If they withhold, it can only be applied to federal withholding, not for Social Security or Medicare taxes. Therefore, you need to pay by January 15th of the following the end of the tax year. You need to pay a minimum of 90% of the tax due, or you may be subject to a penalty. Strategic tax planning begins with your compensation plan. This is the plan that you sit down with your congregation to say, this is how much you're willing to give me, but let's break it up. This is what you fill out at charge conference time. But let's plan this so that all of it is not taxable income. This compensation plan must be in place before you receive any of this money. So you need to be advanced in your planning. Every clergy can have a housing allowance. This is one of the most confusing things for clergy and lay. Even if you're living in a home owned by somebody else, usually the church, you could still have a housing allowance. Every penny you spend on housing, we'll talk about this several times today. Every penny you spend on housing out of your own pocket needs to come against that housing allowance. That housing allowance is not taxable for federal tax purposes, income tax purposes, to the extent it is spent. We'll talk about that. But it needs to be added back in for self-employment tax purposes. I think one of the biggest things you can do to reduce the taxes that you owe is to make those personal contributions to Westpath, through UMPIP. This money must be sent from the church. You can reduce your compensation to make those payments. Let me tell you, as a retiree, the money that I set aside all these, over all these years comes back and is deeply appreciated. So everybody can make contributions. We'll talk about those limits in a little bit as well. Everyone has business expenses. Even if you have an accountable reimbursement plan, you have expenses that are not reimbursed by the church. You may go out and I may meet Ken for lunch, and we talk business. My mileage I don't turn in, or my lunch with Ken, but that's still a business expense, and you want to keep track of that, and you want to make a log of those expenses. Most people don't have to worry about that. I usually say about clergy that 90% of who we are is somehow tied into our business. So we need to keep track of those expenses carefully. So strategic tax planning includes housing. As I said, every clergy person should have a housing allowance. There's a lot of names for this: housing allowance, parsonage allowance, furnishings allowance, utilities allowance, housing exclusion. It's all the same thing. And every person should have, every clergy should have some kind of housing allowance.
Yeah, I find that I talk to people about it, that it's the variety of different names and titles that is a big part of the confusion. And even the IRS, when I've read some of the IRS documents that you've sent me to, even they interchange the allowance and the exclusion and housing and parsonage and all those different terms. So I think that's probably a good chunk of what the confusion is that people run into with this.
Right.
But yeah.
Now, the code that you want to pay attention to is the Internal Revenue Code number 107. You want to write that down, make sure you have it. That's the Internal Revenue Code that talks about the exclusion from gross income for a parsonage allowance, housing allowance, specifically provided as part of compensation for the services performed as a minister of the gospel. Anybody that questions the housing allowance wants to refer to the Internal Revenue Code 107. Okay. The parsonage allowance includes the rental value of a home furnished as part of compensation, or a housing allowance to provide a home, including furnishings. I like the word appurtenances, which means a garage, utilities, maintenance, repair, every single thing that you put inside that house except food is included as part of that housing allowance. A minister could receive a parsonage allowance for only one house. It used to be that you could count your main house, and if you had a cabin, cottage, you could include that. But now a parsonage allowance is only one house. It must be approved annually, and it must be approved in advance of using the allowance. The IRS will allow you to change that during the year, but you have to check with your annual conference rules to see if you could do that. You can't change the bottom line of your compensation, but you might be able to make a higher parsonage allowance, housing allowance to your advantage. This gets tricky when you try to figure that out. It's a housing allowance is the lesser of the amount actually used to provide a home. That's the dollar amount that you actually spend. it could be the amount officially designated as a housing allowance, or it could be the fair rental value of the home, including furnishings, utilities, maintenance, repairs, supplies. Whatever is the lesser amount of those three things is what your housing allowance could be. Most of the time, for all of us, it's going to be the amount officially designated as a housing allowance. What's important about that note is you might have a housing allowance of 20,000, but you spend 25,000, you're out that extra money. You can only declare the 20,000, and the other way around. If you have a 20,000 allowance and you spend only 15,000, you have to designate as additional unused housing allowance, other income on your tax return, the difference between what you had as an allowance and how much you actually spent.
But the point there, Don, I think that we want to make to folks is if you're going to estimate how much of your income you're going to put into this housing allowance and exclude it. If you put too much in, there's an avenue to make that up, which is to just report it as other income. If you put too little in, there's no way to go back and fix that.
Right, you're out of luck.
Yeah.
So high.
So, and the fair rental value of the home, that's one that I think oftentimes kind of people will kind of catch them because they'll say, well, homes like this are renting for $2,000 or $3,000 a month. So I can grasp that. And again, it's the lesser of these three is really what you want to be looking at.
Correct.
And this will come into play, I think, again, when we talk about retirement. And as you made the comment before about the downside of paying off your mortgage, because you still have these criteria that you have to keep in mind. That's
correct. What the IRS says, it may not include food or maid service. You can pay somebody to cut your grass, but you can't pay them to clean the house. Crazy, but that's what it limits. Everything else is included. Yes, even though a housing allowance may be used to pay mortgage interest and property taxes, these deductions are still allowed as a deduction on Schedule A, in addition to taking the deduction for housing allowance. That's one of the quirks that makes it really interesting if you itemize on Schedule A. Retired clergy, my favorite category. Funds received from the church's pension program are considered housing allowance and are not taxable income to the extent that they are spent. What the clergy will get from Westpath is a 1099-R. It'll say in one box how much was distributed, and the other box will be blank. You have to fill that in. So if you receive 30,000 from retirement funds, then and you spend 29,000, you have to report $1,000 as taxable income at that point. Now, one of the things that is important here is it can only come from a church's pension program. Mm-hmm. Many clergy have also money invested in brokerage houses. Those brokerage people say, I can do a better job of investing your money. I want you to move it over to our brokerage house. If you do that, you will lose that much of your housing allowance. So it's only the money that comes from the church's pension through Westpath that counts as housing. Also important to note, pension income is not taxable for self-employment tax purposes. I've seen even CPAs set this up in such a way that pastors paying self-employment tax on their retirement income. No retirement income. Doesn't matter if it's from an IRA, the church's pension, any pension income is not taxable for self-employment tax purposes.
And so Don, I've got a question in the chat window from Rusty saying, if your housing expenses exceed the allowance, is it also deductible?
No, if you spend more than you're getting, then you lose out on any further deduction.
And even on self-employment, how would that work on the self-employment side?
Housing allowance doesn't affect self-employment at that point
Okay,
for retired clergy.
okay. I'm not sure when Rusty's question came in, whether it's about retired clergy or active clergy or not, but I think that covers it.
Business-related expenses, as I said, you can no longer deduct business expenses on Schedule A. Much of a clergy life is business-related. What the IRS says is if you are talking business before, during, or after any kind of event, then it makes that event business-related. And you want to ask the question, are my expenses something that I can deduct? What you need to do is keep a log of what you do, the mileage you use, the money you spend. It's well to, in that log, to even say who you visited or where you went or what you did. Many people have tried to list out, just make up a figure and deduct it. IRS will not accept that. If you got audited on your business expenses and you do not have a contemporaneous log, they will not accept it. You need to have an accountable reimbursement plan. This is separate from your compensation. This is a line item that the church should have that says you can deduct these business expenses. You need to sit down with somebody, treasurer, finance committee, whatever, to define what is deductible under a accountable reimbursement plan. Then you need to turn in receipts, notes, and get this reimbursed to you. That money that you get reimbursed is not taxable income, and it is not a deduction at any point, but is a very important part of your compensation plan.
So the accountable reimbursement is actually church dollars like any other line item in the church budget. If you don't use it all, it's the church's money. And so you haven't, it doesn't come to you in any way at the end. That's
an important part, because if they paid you whatever was at the balance of that account, it negates the whole thing and that all becomes taxable income. We've got to be careful with that.
Oops, sorry, too fast. There you go.
All clergy have expenses that are not reimbursed. So you need to keep track of them. We'll be able to deduct them against our self-employment tax, as we'll talk about later. So it's important that you keep track of these expenses. As I said, you have to ask the question, is it a business event? And then if it is a business event, is the expense deductible? And do I have a receipt or a record of payment? You must have a receipt for anything over $75. Otherwise, a contemporary record saying, here's the date, this is what I did, and this is the amount. Now, when we say, is it a business event? I find that a lot of clergy go out to dinner after church on Sunday. So is that a business event is the first question. If there's business discussed before, during, or after, then it makes a business event. Is the expense deductible? Your expense for dinner would be deductible, but your spouse's expense would not be deductible. Also, extremely important, we get this question all the time. Is my contribution to the church a business expense? No, it is not. Also, as a stewardship thought, don't say to the church, well, just keep my money that I would give to the church and I'll not make a contribution. Nobody in your church is allowed to do that. Why should you? The other part of that is then you tell the congregation that you're not making a contribution. So you got to be careful. It's not a business expense. You do not want to have the money taken out of your salary before you ever receive it. Every clergy can have a personal pension plan contribution. Those personal contributions are deducted from your compensation and must be paid to the Board of Pensions, Westpath, directly from the local church. That money is not reported on your W-2 as wages. It may be reported under a category called E back later on the W-2, but it is not taxable income to you for either income tax or self-employment tax. In 2022, you can contribute up to $20,500 plus an additional $6,500 if you're over 50 and have had wages 15 years of service. What I suggest is you talk to Westpath about this. That really adds up. Again, that money is withheld from your paycheck and paid directly by the church to Westpath and is not reported as wages. It adds up and it makes a difference. Here's one example. If your salary were $42,000 and you had a housing allowance of $12,000 and you paid into your personal pension $3,600, then your taxable compensation for income tax purposes, the amount of money that is listed as wages on a W-2 is only $26,400. So that makes a huge difference. So if you're in a 12% tax bracket, on income tax alone, you'll save $1,872. Your pension contribution, you'll save another $540, which will save $2,412 that you'll save on your income tax. So these things add up and make a difference. Now, under self-employment tax, it's your taxable income plus your housing allowance minus unreimbursed business expenses, which I suggest you report on Form 2106, which then allows you to justify why you're taking that off of your self-employment tax. What does this look like? Well, if our taxable income is $26,400 under our previous example, and we have a $12,000 housing allowance, but we had $3,400 of unreimbursed business expenses, then our self-employment tax is based on $35,000 at a 15.3% tax bracket. Now, remember, we started out at $42,000, but even for self-employment tax, we've got it down to $35,000. That's taxable, not $42,000.
And that $3,400 of unreimbursed business expense looks like a lot right away, but that could even be like a personal computer that you use to work, or a laptop that you use to work on your sermons, right? That would be an acceptable.
Yes. So what we did was we saved $2,412 from income tax, $510 from self-employment tax. So we've saved almost $3,000 by taking advantage of these things that the tax rules say that we can do.
Great. And we've got a question from Stephen. It says, can we also deduct the business portion of Social Security, Medicare on the SE form?
No. You can't. You could, you might, if, yeah. No, that's not a deduction. That's not a business expense.
Okay. Back here.
Also, clergy should be paying a fourth of their total estimated tax due on 4 dates that are normally there. What you need to pay is by January 15th, you need to pay a minimum of 90% of the tax due. That includes income tax and self-employment tax. All right, financial planning is imperative. Start with a spending plan. As was mentioned quite a few years ago, I wrote a book called, well, it was on financial planning for Christians. And I changed budget to spending plan. A budget just says, all right, this is how much I'm going to allot for different expenses, oftentimes with no justification. A spending plan is a plan on how you're actually going to spend the money that you have coming in, using either a software program or a piece of paper. Write down how much you're going to get out of a paycheck, and then write down how much you're going to, where's all the things going to be paid for out of that. That's what a spending plan is. I also like to say that any money that we may have saved from taxes today, first use it to build an emergency fund. Most financial planners say you should have an emergency fund of 6 months of your income. I find that impossible for most of us. Start with building up an emergency fund of a week of your income. Move to a month of your income. This is going to help you save a lot. After you build up an emergency fund, use that extra money that you've saved from not paying taxes to reduce your debt. 2 ways of looking at that. One is to look at your debt with the what's the highest interest rate and pay that down sooner, or take a look at how much you owe on different debts and pay the one that you owe more on. I like to say, whatever my higher interest rate is, I want to pay that down first, because that's going to help me save a lot of money. Also, I'd like to suggest that any money earned outside of the local church should be spent according to your plan. So money that you get from weddings, funerals, outside speaking engagements, whatever, build up that emergency fund and reduce your debt. Okay.
That's it. We've only had a couple of questions in the window. I don't know if anybody else has any questions that they want to lift up. Let me also mention there were a couple of questions that came early, and one of the questions caught my attention. I think we covered 2 of the 3 that were sent to me, but one of them had to do with the situation the United Methodist Church finds itself in right now with the division and the possible departure of churches from the denomination, how does that impact on your local, on your taxes and also on your pension and housing allowance and things? And I think, you know, when I saw the question, I worked closely with Westpath. I'm on a number of different interagency groups with them. Westpath has really kind of gone out of their way over the last decade or so to identify themselves as being broader than serving any one single denomination, and they have kind of positioned themselves, and I think in much of what we talked about as churches leave, to be able to continue to support pensions from people who come out of our tradition. So I really don't think that part's going to affect anything as different churches may decide that they want to leave the United Methodist Church. Don, do you want to speak to that at all, or?
No, just to say that especially your pension funds are very secure at Westpath, and no matter what happens of any kind of split or not split, your money is safe.
And the tax rules are really for clergy all across denominations. There's nothing specifically in there that we get because, you know, United Methodists get a special deal or whatever, but
That's right.
So, you know, housing allowances, those kind of things, how we do our taxes situation apply to clergy universally.
Correct.
Okay.
Thank you, Ken and Don. There's a couple questions, I guess, in the chat. I don't know if we have any follow-up questions. Do you?
Yeah, the question here is about the challenges that have been made to the housing allowance exclusion in the federal courts. And I guess that would be the case that went up in Wisconsin, that our lawyers were very much involved in the team that went to speak to that case. And what I've heard from the attorneys at GCFA is that the group that was bringing these concerns to the courts and challenging these things were groups that were really about trying to not have special benefits for churches. And what I've heard from the attorneys is that they really don't want to push this to the Supreme Court because of the conservative nature of the Supreme Court. And once the Supreme Court rules on it, it'll never be able to be brought up again. And so what Brian Mills and others who are on the legal team that did that have kind of shared is that the fact that this ruling came in favor of the parsonage system and that allowance, that the group that had challenged it really has sort of backed off now and said that this is not, the next step would be for them to take it to the Supreme Court, and this is really not the time to do that. It doesn't mean that it will never be challenged again, but it seems pretty secure at the moment that that they didn't really want to necessarily roll the dice with the Supreme Court with the makeup that it's in right now.
Right. And let me add, the parsonage allowance or the housing allowance is really set up for the military. So the military that are living in either housing provided by the military or giving you an allowance is how we get on that coattails. And it's not just for clergy. So it's a little ironic at that point.
Sorry, I'm scrolling over. I'm scrolling over a question and I'm moving all over places I shouldn't here. Okay. So Rusty asked the question, if the spouse is in a non-clergy retirement, should the clergy consider filing as self-employed as opposed to filing jointly? I mean, I think what you mean is filed as single as opposed to filing jointly?
There's no advantage in the tax code to file married filing separately. So I suggest, I have several people I do their taxes that want me to do their taxes both ways every year, and they pay me to do that. I've never found a time when it's to pay less taxes because we're separating them.
So one of the questions that one of the points that I don't know if you made or not, Don, you made it other times we've done this, which is good, is that this benefit for retirees is only during the life of the clergy. And
Yes.
so go ahead, I'll let you kind of finish that thought.
Yeah, when the clergy dies, the pension that the remaining spouse gets from Westpath is no longer housing allowance. Taxable income.
So at that point, the spouse would no longer have the advantage of that. If they wanted to at that point, then finish paying off their mortgage or whatever, it would have much less impact than doing that while the clergy was still receiving money from the Board of Pension.
Precisely.
Yeah. Okay. Well, if there's no more questions, I think I appreciate everybody hanging in there. We've gone a little bit over, but
Yeah. We're good. Ken, thank you. Don, thank you so much for presenting this webinar today and for the great information that and insight that you've both given us. The webinar was recorded and we will post it on our website within a few days. And our website is www.umf.org. We have another webinar lined up for March 9th, Wednesday, March 9th. You'll see a slide coming up on your screen, inviting generosity beyond the Sunday offering. It will be led by Ken Sloane, and we're very privileged and blessed to have Ken lead us off this calendar year with 3 webinars, and that'll be the third that he's helping conduct for us. Is your church ready to receive gifts that won't necessarily come through the offering plate? And does your church have a strategy in place for gifts that might take the form of a bequest, an endowment, memorial gifts, or gifts of property, stocks, or valuable collectibles? And I guess another question that's always pertinent is if you're approached by a church member or another potential donor who would be offering this type of a gift, would you know how to respond? Well, no worries. Ken is going to enlighten us on Wednesday, March 9th and walk us through some thoughts and some ideas of ways to invite generosity beyond the Sunday offering. You'll see a QR code where you can register right now online, or you can go to our website on www.umf.org/upcoming events, or just go on our main website, scroll down, and you'll see a screen that has some offerings. Click on that, will take you to the registration for that webinar. As always, our webinars are free of charge. They just require registration in advance, and we hope to see you on March 9th. Thank you for thank you for joining us today, and we'll say good afternoon, and thanks again to Ken and to Don for their time and for their insight in helping us today. God bless all. Take care.
Thanks, folks.